Sweet. I got Christopher Huffman here on the Capital Raisers show. I am super impressed with this young gentleman, 26 years old. I can't wait to dive into all kinds of topics, particularly one that I'm very fascinated by, creative finance. Christopher, welcome to the show. How are you doing today, man?
Doing good. Thanks for being able to have me. Super excited for today.
Yeah, pumped up. You actually found me through one of your marketing campaigns on LinkedIn, if I recall correctly. And I thought that I'd friend requested you, but then I went back and saw that you said, and so I went on your profile and it said champion apartment investor. And I was like, what? I got to talk to this guy. So I got you on there and that was a lot of fun. So we had a great conversation and now you've joined me on the show. So thank you so much for coming on.
Been incredibly impressed and been able to, see a lot of the things you've done. And I couldn't resist, to be able to be around like-minded people. So.
All right, cool,
Thanks.
man. I try to be fun, so I appreciate that. But so
Doing a good job so far.
Man, there's so much stuff that I want to go into. So you started out with a nightly rental business and you were renting out cabins. And then your progression and everything that you've gone into, it's been like developments using creative finance, 152 unit subdivision worth $34 million that you dropped $12,000 earnest to get in. And everything else, I think, has either been creatively financed. And now you're doing your first syndication. Man, let's go way back and start which it wasn't even that far ago, man. You're like 26 and you started like 3 or 4 years ago. You are moving very quickly. It's very impressive. Tell us about how you got started in real estate.
So there's a single individual that got me started into real estate day one. It was actually a professor. I went to Utah State University, and it was one of the individuals teaching my class. And, I knew he'd done some real estate stuff in the past, and I have no connections or ties to real estate family-wise. Nobody else in my family has been a syndicator. They've been all in other industries. And, we visited for a few minutes, and I asked him out to breakfast. I said, hey, you want to go get some food and just tell me more about what you do. So the next morning we went out and we got some tasty food. He taught me what a cap rate was, taught me how to, what a net operating income is and why investing into real estate is really fun. And I think from that day forward, I have been hooked ever since. So that's initially how it started. And I was still a full-time student, a new father, no clue what in the world I was doing, but I just knew it sounded like it was something I really would enjoy.
What did you picture yourself doing before you found the world of real estate?
Something to do with numbers, finance. A lot of my family, I've had individuals, whether it's in private equity or in the health industry or in private business. And I love numbers and being able to help people understand how to measure a return. And I knew I really liked people. And real estate kind of has a mix of both of those. It's very numbers oriented and it's all about your relationships and your people. So, seemed kind of like the best of both worlds.
Cool. Let's break down some of the beginning deals. I know you were in a rental business and you had done a couple of fix and flips. Who taught you? Because the person that you're talking about, the professor, I saw on your LinkedIn that he was associated with an individual that has a very large number of units in Utah, I believe 30,000 units. Mm-hmm. So you saw multifamily, but you didn't jump right into multifamily. You started with some other things. So tell me about how you got into these other deals and then how you progressed. How did you raise the capital for them? What did you do? There are a couple of single family fix and flips. Tell me about those deals. I want to hear about those.
For sure. So ultimately, I really never knew I wanted to do multifamily, even though it's been right in front of my face since I started. The individual I was talking about was the old CTO for a big real estate developer here. And so he did all the technology and he saw all the data coming in and out. And he saw how much money this company was making buying 3, 4, 5, 6, 100 unit apartments. And he's like, I got to go and do this by myself. So he left, is doing that full time now, and he teaches on the side. And essentially, when I started out in real estate, I started in that nightly rental company before Airbnb, started to get really big, just with another student. And we kind of went through that process, and that's how I met one of my current partners in our development company. His name's Ethan, and he's been beyond incredible. He brought a lot of that experience to the table and he had a lot of the know-how. I just had a lot of I'm willing to work 18-hour days and work my absolute tail off to figure it out. So with my relationship with Ethan, we started in the development field. He worked for a heavy construction company. So we, started playing around with something called land entitlement. It's where you buy and purchase land. You get it through the city, and the entitlement process is when you get it approved to change the use from agricultural into either residential, commercial, or multifamily. And so we played around with that a little bit. We did a 20-acre subdivision up in Midway, Utah. It was kind of a luxury home market. In between all that, we just hustled. There's a variety of things we can go into for how we found. We went through a couple of different fix and flips, a few other we've been through a lot of different kinds of property.
Cool. So actually, I'm curious about the entitlement phase of things because I'm somewhat familiar with it. We used to be trained by a gentleman named Mike Watson, who was always talking about higher and better use. And one of the things that you can do to create a higher and better use is to go through entitlement phase, right? So you take a piece of land, and to create a higher and better use, you can fully develop a full-blown asset, like a multifamily or a mixed use or an industrial, or you can just do some things along the way to increase the value or force appreciation or create a higher and better use. This entitlement phase deals with working with the city, and you're talking about changing the zoning, but it also entails a couple other things like getting the electrical installed, or maybe putting some asphalt or creating some structure to the land that it didn't have originally. Is that correct, or is that another phase?
Absolutely. So the development, I like to think about it in 4 phases. The first phase, you have your entitlement process, which is where you're going to go change the zoning through the city. You're not going to move a shovel. Phase 2 is when you're doing the horizontals, which is essentially everything the ground down. So you're going to do your sewer, your water that runs underneath your main street. You're going to do all your utilities, electrical, over on the side. Sometimes it's under or near the sidewalks. You're going to do the streets. And essentially, the end of phase 2, you have completed lots that are improved. Step 3 is the vertical build, which is where you actually will go and pour a foundation, attach to those utilities, and build a house, which is what a normal builder would do. And then the 4th stage is to sell the homes and go celebrate with some wonderful vacation somewhere that everyone, could be really excited about.
Yeah, and you can go into these projects, considering the end result is the finished project with an exit strategy along the way that you can sell at any given point for a profit. Mm-hmm. You can do it at phase 1, you can do it at phase 2, you can start phase 3, and in the middle of the phase, somebody can come in and say, hey, we like your project. We'd like to finish this off, for you and mm-hmm. do it ourselves. What would you sell it for? And at that point, you can walk with a profit and go on to the next deal or whatnot. But yeah, that was one of the strategies that Mike Watson taught us. He's actually from Utah. He's no longer around. He used to talk a lot about, I've never lost money on a deal. And I think he ended up getting sued, or I'm not totally positive. I don't want to get nailed for defamation of character. He's a great guy. I loved training with him, but I haven't seen him around. So hopefully he's doing good.
Fingers crossed.
Yeah. So let's go into that. I think what I'm really curious about is, so your friend was in the construction arena. Was it him that knew how to talk to the city, or did you have to figure it out on the way? And what was that process?
It was a lot of learning. It was fairly new to him, but he had more experience than I did. We knew how the general process ran, but correction, he knew how the general process ran. I was a college student who had no clue what I was doing. And one thing I did, throughout, I'd meet with other developers, other investors, other people who had far more experience than I did. One of the things I did during all of those meetings was, if there was ever a word I did not understand, I would, say, hey, I got to go to the bathroom really quick, or I got to, just stand up. And I would go out into the hall and I would literally write down on my phone what we were talking about. And I'd write down any words I didn't recognize. And then that night I stayed up late. My wife, can attest to this. I stayed up for hours and learned everything I could about whatever it was I didn't understand, so that the very next day when I followed back up with them, I actually knew what in the world we were talking about. So, it was kind of a learning by fire, so to speak, a little bit for both of us, but I think he had a lot of the know-hows, like to do with the construction aspect, and to know essentially that we weren't being, taken control of or taken advantage of by a contractor. And he had a really, really good reputation in the market.
So when seeking a mentor, I think I just read in Hunter Thompson's book that a mentor likes to see these high performance indicators in the people that they take on. And one of them being, a lot of passion and drive and exuberance for learning. And I see that in you, and I commend you for that. So when you were learning all of these aspects of entitlements and the construction and dealing with the city, at some point, because I know you started working in creative finance on your deals, did you study creative finance? I know you mentioned earlier that you love numbers so much, and you can talk to people in such a manner where it's maybe you're more inclined to be able to sell than other people because you are so well versed in the number crunching aspect of it. But you didn't mention how you learned the creative finance side. So let's actually first talk about what you did in regards to your move on. Well, let's move on. We're talking about a 4.5 million development. I think this might be your second major deal. And then you got it 100% financed with none of your own money. So tell me, how did that occur? What was the process? I mean, did you have to learn about it before you financed it, the creative side of things, that is, or did you just do it organically on the ride?
So this was building your parachute on the way down. 110%. We had no clue how we were going to finance it. No clue how. All I know is we had a contract and we had a closing date. When I started in this a couple of years ago, I had no clue how to crunch numbers in real estate. All I knew is numbers are really fun. And I didn't know, really much about Excel. I didn't know much about really anything. All I knew was that I was willing to learn it. And so, I'd stay up at night and I'd look for how other people analyze developments and what things I was forgetting. And then, so I was really just building that on the way down. But we initially were going to in a lot of our creative financing, we've used second position debt. So for those of you that don't know what that means, is typically when you buy a house and you get a mortgage on your house, the bank is in first position, which means that if anything goes wrong or the property sells, they are the first to get paid. They have the strongest position, and it's the safest place to be. A second position debt is exactly that. It is in second place behind a mortgage. A lot of people know second position debt as like they have a second position line of credit or a home equity line of credit, but they still have a mortgage. Maybe their mortgage is $200,000, but they have a home equity line for $30,000 or $40,000. Similarly, we would go out and raise second position debt from investors. So we would originally how we wanted to finance our Midway deal was we were going to have a bank finance the first position loan in what's called an acquisition and development loan, which I had to learn what that was. But they'll finance the acquisition of the land and the development of the parcel. And there's a lot of hoops and ladders in that one too. But essentially, and then we were going to be able to we had to bring in about $400,000 to $500,000 worth of second position debt.
So they agreed to this when they qualified you for the first loan. They knew that you were going to bring bring money that you didn't have yet.
That's also where we got creative. We couldn't qualify for the loan. So we actually went and hustled, and we actually paid for a guarantor.
Cool.
So somebody else who we had a good relationship with, they know us and trusted them. We paid them a small flat fee for them to guarantee and sign on the loan for us. So we had somebody to be able to guarantee and sign on the loan, and then we were going to have somebody else bring in the money to be able to finance that loan. And we used what's called a convertible note, which is how we've collateralized some of our second position debt, which is essentially that we can say, okay, it's going to be tied to a trust deed and a promissory note in second position. So it's going to be a debt financing similar to like a private lender. And we're going to give you 12% on your money or 15% on your money.
Mhm.
If we don't pay you, you can convert this note. We were essentially being willing to leverage our future paycheck for the investor's collateral with them being into second position.
And that covered all of it? So that's 100% of the financing, or was there still more debt that you needed to create or in order to finance
That
it?
was going to be 100% of the financing. And 10 days before closing, our second position lender, we had a verbal committal. And about 10 days before closing, they ended up placing their money elsewhere.
Wow.
So that week, I think I met with 34 banks and the number of lenders, literally morning to night. I don't know if my wife even saw me that week. And I think one of the very last people I talked to, I explained what had happened. I explained the whole situation. And he actually said, hey, don't take money from a bank. I'll finance the whole deal for you.
So he ended up financing the entire thing. So you just quit on the first position debt and the second position, and then just got this gentleman.
A week before closing, and this gentleman, at first when I walked out of his office, I thought he was joking.
Yeah.
And we essentially came back. I talked to him the next day and he's like, okay, so what do you need? You know, what do we, I'm like, I was literally completely in awe. And this was just a very simple first position note for the entire, he financed the purchase of the land, the engineering costs, the city costs, and everything essentially. And then we got the sellers to pay us a commission. So we technically got paid when we closed, and we're able to use that money to be able to survive off of until we were able to, you know, continue to get other, like it was so creative and I don't know if I could do it again if I tried, but it was,
That's awesome.
hustling.
And then when you got the property under contract, you didn't have to leave an earnest money deposit, or was?
So I have to be truthful. We did put money down. We did put $100 down on the contract. So,
$100. Oh my.
yeah.
Wow, man. That's impressive. That's really cool. And you did this at like 24 years old?
This was at 22. And then, that was just, you know, just under 5 years ago. So that Midway project was kind of my first entry into real estate. Throughout that whole process, we picked up fix and flips. We picked up just a variety of other asset classes. And I slowly started to realize that, I mean, essentially, I need to focus on what I'm good at. And which is why I've shied away from residential. And which is why it kind of landed me in multifamily into where I am now. I learned the very sudden realization that I don't know how to sell a wife on a countertop in a kitchen, but I do know how to sell an investor on a return.
Yeah.
I love numbers, you know, the income approach of appraising and being able to understand. I learned and understood the number side from hours and hours and hours of learning. My passion just was not in selling residential.
Oh, I get it.
I wanted to do
I
things that
tried
were more
selling
numbers
too.
based.
And then, so what were you studying to learn these numbers and these crunching of numbers and these cost approach appraisals and things of that nature?
So I was a full-time student during all of this, and there was a few basic things in school I learned with accounting and whatnot when I was younger that helped a little, but I was on Bigger Pockets. I had podcasts, you know, Joe Fairless was incredible, Brandon Turner. I mean, I listened to any possible podcast that I could, Cashflow Ninja, and I'm sad I didn't have yours because that would have been really helpful.
It didn't exist back then. I just launched it a couple months ago.
You know, but like I was just grabbing at any other information I could. I made a list of 20 people that were doing what I wanted to do in Salt Lake. And I reached out to every single one of them and said, hey, I'll buy you lunch.
Yeah.
Or I'll come to your office for 20 minutes of your time and I'm willing to work for you for free.
Yeah,
I'll do anything.
I think that's a really big deal when people they want to get paid before they can provide any value. And I mean, even in the Rich Dad Poor Dad book, he tries to teach people to work for free so that way they can grow faster. I think it's a great concept, and I would be willing to work for free to learn the things that you learned For sure. But so walk us through, you moved on from this, or maybe even while you were doing this $4.5 million development, you moved into a subdivision deal. So tell me about that deal, how you found it, when did you do it? Did you have the other project going simultaneously? Tell us about that deal.
Yep. So this is a 20-acre piece of ground, about the same size of ground. And we found it off of, I think I was using Spokio. I mean, Spokio is a white page service. You pay about $30 a month. And I looked at a bunch of pieces of ground and I just started picking random pieces of farm ground. I called the owners and said, "Do you want to sell?" And eventually after, hundreds of calls, I got to one that says, "Yeah, we'd look at selling." It was an incredible family, Westerner family, and a Southerner family, the funnest accent. It was great. They were the nicest of people, and they were interested in selling. They didn't even live in the area. And we negotiated a seller finance deal with them. And I got my investors to come in and float the down payment for that seller finance.
Okay, so let's stop right there. I want to know what you said to get them to seller finance. A lot of people say that seller finance is better for the seller than it is for the buyer. Tell me if that's the way you pitched it to them.
So we pitched it as they wanted this much. We can only afford to pay them. So for those not looking at a screen, we afford to pay them. They wanted $100 for the land. We were only willing to pay $85. So to be able to make up that 15-point difference, we were able to say, "Look, we can only pay you this much now, but look, we'll give you interest on your seller finance over a 3-year period of time. And then if you add up all the interest that you make on this land, plus what we paid you for, you're going to be much, much closer to what you want to get, of what you wanted to get." Really, I started to understand the situation that the actual family was in, and they didn't want the money. For taxes, there was a partnership with some siblings that they were still trying to work out, and just a variety of reasons. So I could tell for them, it made more sense if I could negotiate a seller finance deal. And I just helped them understand about us and that we actually had the ability to deliver. And that contract, I think, was like $600. We said we'd pay him $655 for the ground. I think we gave him about $100,000 up front. Non-refundable day one. Well, non-refundable when we close on the land. And I think the earnest money on that was also $100. So.
And then that $100,000 you raised from your partners?
Yep, we raised that was a second position debt note. And for the 2 years, that was just in the second position debt in the background. $100,000 for the initial down payment, and then we raised another $100,000 for the city fees and improvements, just to get through to entitle the land. Because I learned that then the bank will pick up all of those fees. They'll reimburse you for what you spent and pay for the ongoing development. So,
and that money that you raised, was it debt or was it joint venture partnership money? What kind of, when you say raise it, are you talking about actual debt or are you talking about actual equity?
This was a debt that had certain elements of equity mixed in.
Okay, let's go into that. This is fun. I want to hear more about this.
So essentially the debt I'm trying to even remember, this was a while ago. We had, and hopefully I'm not getting myself in trouble because we did something we weren't supposed to. It worked out really great and all the parties are happy, but essentially we again collateralized things with a convertible note. So we said, we'll pay you this debt, but we're collateralizing equity. And that we had a few other things within our LLC that we helped to be able to kind of work out. So it was structured like a joint venture, even though one of the partners had a second position debt on the property. It was because of a really good relationship with literally some of the most fantastic people.
Awesome.
That we knew, they trusted us, they knew us, it was in our warm circle, and they had some money they needed to place, and we worked out a deal that made sense for everybody.
And then keep on telling us about the deal. What was this deal? It was a piece of land and your intent was to create 152 units. Tell me about everything that you wanted to do to this piece of land.
So it started as a 43-unit residential subdivision. And essentially we went through the city and we actually got denied on our rezone twice over 6 months. We lost over $40,000 doing it. It was definitely a big learning curve. But then going through that, we learned that the state was starting to push for affordable housing. And this particular city does not have any housing, any affordable housing or ordinances in their city. So we, over the next year and a half, we helped the city hand draft an ordinance for multifamily. They repealed this ordinance back in 2008 or 9 after everything with the recession happened. And we actually helped them hand draft an ordinance with our piece of ground as the guinea pig, so to speak. And we went through that, and that took, so we actually are still doing that development. It's actually 142 lots or 141 based on the final construction, but we're about 2 months away from that being approved. So it'll be almost a 3 to a 3.5 year process.
Yeah, you guys were motivated to get something done because you had $100,000 hard on that.
Yep.
So that's really cool that you guys were able to work something out with the city. And then, so while you're doing this, it's now a $34 million project that you guys are up to. You're still in the middle of it, it sounds like. And you have now moved into multifamily syndication, starting at the 506c level, which is a specific type of capital raise. Tell us about why you decided to move from all of these developments into another asset class, which is multifamily.
Yep. So, I started learning, I mean, like with our personal goals and for what I wanted to be able to achieve, I knew I wasn't going to get there doing residential flips. We've done a variety of those. You might make, you might make a little lump of cash, but I started to realize that even with developments, you get an engineering bill halfway through the entitlement process you didn't anticipate, or you run out of money. When your engineer calls for money and you say, hey, I'll get you paid in 8 months when our first lot sells, that doesn't float. So I started to realize the need for cash flow and to have existing cash flow day one, which is where we wanted to buy existing buildings. And from my initial mentor, all they bought was multi-hundred unit apartments. And I started to learn that it aligns with all of the things that it aligns with my strengths. There are other people who are in new development and it aligns with their strengths, and you can make money in all of these things. For me personally, I wanted to buy something I could cash flow with day one. I could be able to preserve principal. So I could be able to have some kind of, with apartments, if the economy crashes, people still need a place to live. And I'm not going to be hanging on to a new development that's halfway finished. And it just complemented numbers. So, I figured the bigger, the better. And Adam Adams was the one he's another syndicator out of Denver. He was the one that essentially said 100 units plus, that was kind of his cutoff. He's like, anything lower than that, it's not, he's like, the bigger, the better. You're just adding a few zeros. And when you start buying bigger stuff, it becomes a lot more about relationships and creating systems.
Yeah.
Yeah.
It's interesting that we were both cruising around that event, the Raising Money Summit, and we didn't even know each other.
Never saw each other. Never met.
Many months later before we found out that we existed. So that's kind of cool. Okay. So tell me about the deal that you found, and let's start there before I ask you the next question.
Perfect. So running through a few of it, it's a 50 unit deal. We were only looking for stuff that was more than 100 units. And I had a really good friend of mine, Emma, came up and she was asking, I was a numbers guy, I loved it. And so I helped underwrite a little bit of the deal. And I started to realize that this is an incredible deal. I've underwritten so many deals and was looking for a multifamily project. This was in Pocatello, so it's about 2.5 hours away from me. It was close to home. I had a couple of connections up in Idaho. Emma was fantastic, and we started working together, and it just made sense. So I found Emma through, we met at a networking event, like a Utah RIA meeting. So even though some people think that those are terrible, you might just meet your next partner that's going to help you do your next deal. I think they're fantastic. Networking has been a huge aspect. We found the deal. It was at an affordable price. The sellers were motivated. It was a very heavy value add property, and we're actually closing on it in 3 days.
Really? Okay, so if it's a very heavy value add, that means you're probably not getting traditional financing on it. Tell me about what kind of lending product you ended up going with.
Yep. So we're going with it's referred to as a bridge loan. So it is an interest only option. Typically, it has a slightly higher interest rate, but you're not paying down principal so that you can still afford to cash flow. So it's through an institutional, like a government-backed lender. They do bridge loans so it's a 24-month bridge loan, that it's just a temporary financing, and then we refinance it 2 years, which means that we get a new loan that pays that off. And then our new loan is going to be a 30-year fixed loan. But bridge loans, they don't work with every property super well. Like when you're going to government-backed institutions like Fannie Mae and Freddie Mac, they don't like heavy renovations. If it's got too much renovations or the occupancy is low, you'll never qualify for the loan. Bridge loans are a good solution.
I've come across a lot of investors, a lot of multifamily syndicators that are freaked out by bridge loans. They're like, oh, I would never do a deal that required a bridge loan because it's already in disrepair and I don't want to do stuff. Like I want to stay in B plus assets. But some people that are really a little more risk tolerant love heavy value adds, or at least good value adds, because of the amount of potential forced appreciation. And it's worth the risk to get into a deal using a bridge loan, knowing that they can finance it, once they get the occupancy up to 90% for 90 days, boom, you get into a finance. One of my questions to you though is the lender that you use, that's a government bridge loan. I haven't heard of that yet, but some of these people have come across me at IMN events, these lenders, and they say, and I tell them what kind of lending products we use because we use a lot of bridge loan financing as well. And they say, well, we can put you into a bridge loan that will convert to a Fannie Freddie loan, or they actually come and bring both products to me. Whereas what we've done in the past has typically been somebody that just does bridge loans. And then if we ever decided to keep it and convert it to a Fannie Freddie, that would be a completely separate lender. So was your lender somebody that has both of those products available, or are you getting those from different companies?
So both. Yeah, so they would provide us both. Typically, lenders will have if they're doing your bridge, they'll say, if you go to us to do the 30-year, we'll discount our points or we won't charge you a fee. But if you go to somebody else, then there's typically like a soft fee that you have to pay, kind of like a prepayment fee if you don't use them. So they have the ability to go to Fannie and Freddie, which is great. They already underwrote us, and so the deal will be super easy. Our lenders have been great. They will be, they'll have the ability to be able to do the loan once our property is stabilized. But if we so chose, we could go elsewhere to essentially any other lender. But I don't see any reason why we would need you.
Cool. And then on the capital raising side, for this syndication, you have a background in development and subdivisions and entitlements, and even some further expertise in fix and flips, but you've never raised money for a syndication. So when it comes to explaining your track record and having deals that are of like nature in your past in order to convince people to invest with you, you don't have that, but yet you guys are going after this deal and closing in 3 days. So how did you get the money? What did you say to convince the investors or present them an opportunity and get them to believe in you enough so that they would invest with you?
So I think that, it's a balance, because when your investor asks you for a track record, they don't really care about the past projects you've done. All they're looking for is reliability, that you can actually do what you say you're going to do. They're looking to be able to have confidence that you're the guy that they're going to give your money to. So if you have an incredible track record, most people don't even care about the deal. There's some individuals who have such a track record, they say, I need $1 million, and it's sitting in the account. They don't even ask where it's going. They know, and that's one of the benefits of track record. Now, when you don't have a track record in specific categories, you have to be able to essentially know every single in and out of what you're doing. You have to know this deal better than the guy that has the track record. You got to know so that your investors can have the confidence that you know what you're going to do. Yes, this is technically like AIM Capital as a company. This is our first 506c syndication. This is the first time we're publicly raising funds for an investment, but this is not the first time of us doing a deal this size. It's not the first time of us raising capital, dealing with lawyers, being able to deal with value add properties. So we had a lot of those pieces, which our investors were able to understand. And also we brought in another partner as well,
Nice.
who's been involved in almost 1,000 doors, had a lot of that credibility. His name's Frank Padalino. He's been phenomenal. He's been an incredible partner. And yeah, he's been very, very instrumental in helping with a lot of this from his experience, from mine and Emma's. Like it's been a group effort, but the 506c route is definitely, you asked why a 506c versus B. Let's just say they both have their pros and cons.
Yeah. Okay. We don't have to dive into that. I'm curious about, we had mentioned capital raising. I had a previous conversation with you. You actually share an office with a company that specializes in marketing. I believe they're called Divulge. Is that correct?
Correct.
All right. So what is it that they are doing for you? Do you mind sharing about what they are helping you with in regards to getting new accredited investors and what they could do for other people that may be listening on the show that are looking to seek that for themselves?
Absolutely. It is about the easiest thing for me to talk about because of what a good job they do. Yeah, so Divulge Capital, a lot of their focus is on helping speakers, influencers, authors, brand awareness, helping you, if you have a message, helping you get out there and being able to backtrack to the psychology behind what you're offering. So they've been able to help us in our marketing material be able to attract very specific niches of people, and they specialize in Facebook advertising. So they built out all of our funnels so click funnels. They did all of that for us for this project. They do all of AIM Capital's branding. They help us with events. I'm sure we'll talk about it here in a couple minutes, but about our podcast we're launching in about a month and a half or so. As far as other people and what they can offer with, what I love about them is they won't work with everybody. They'll only work with you if you're ready. They're very good, and they essentially are really good at tracking the data and being able to collect it into a database to then help you make sure that you don't miss follow-ups. Make sure that you can be able to get qualified investors who are actually interested in investing and people who can actually research you and know what in the world your brand is. So I don't know if that answered that, but they are incredible.
That's great. Yeah, I have one more follow-up to that, though. Did you have them hired before you went into this syndication, this 506c?
Yes. So Divulge and I have shared offices for almost a year now. The owner of Divulge is an incredible friend with me. I've kind of watched Divulge grow from doing, a very small amount per month, a little while ago, to now them just completely blowing up overnight. He's been able to watch me on my journey as well. So it's been a very mutual relationship.
So what's in the future for AIM Capital? What are you guys going to do?
So our goal this year, I'll say this publicly so that people can hold us to it. Our goal in 2020 is to take down $40 million worth of real estate, through the process of 506B and C syndications and joint ventures. So not everything we do is 100% syndications, but the majority of them are. So I want people to know exactly what we're doing. We're in a couple of different markets across the U.S. that we're looking right now, that you'll hear about here shortly if you follow us on social media. We've got a couple of really fun projects immediately following behind this one.
Very cool. Okay, so tell us about your podcast. It's called Real Estate Syndication Mastery. Why did you come up with that name? Who are you targeting? What's the purpose of it? What do you want to do with it?
See, this is where I'm going to need to spit this back to you, Ruben. You've got, you're a couple steps ahead of me with podcasts, but there's a lot of people who I have calls with and who talk, and they literally just want knowledge. They just want to be able to learn about something specific. There's a lot of podcasts out there, and they're great podcasts, but they're so general. You never know, you never really know what topic it's going to be on, which is good because it's a wide array. Some of them can have a variety of fluff mixed in.
Mm-hmm.
So we want to be, I named it Syndication Mastery, Real Estate Syndication Mastery, so that people can know that we focus specifically on syndications, larger deals. We're going to talk about the meat and bones of investing. Our audience would be, other syndicators looking to learn, maybe who, have never done syndication before. And also a lot of our limited partners and a lot of people who are looking to invest in our deals will listen so that they can understand how we're managing their money.
Yeah, that's good. I think if I had done it differently, I may or may not have considered creating a podcast to help attract passive investors. But I don't really have any regrets because I've been able to study the capital raising methods, the mindset of raising capital from a variety of successful syndicators. And I've had a variety, just nonstop paradigm shifts from talking to these people. They've just helped me so much and provided so much value to our audience. The Capital Raiser Nation. By the way, give us a 5-star review if you have a chance. We always love that. We're trying to grow so we can get better guests. But Christopher, you've been phenomenal. I do want to do a real quick segment here that we've introduced. It's called the lightning round. And I'm going to ask you a few questions and then you get to answer it within 10 seconds if possible. And we'll start with this. Tell us about your favorite drink.
Favorite drink is water. Sounds funny. My wife always makes fun of me, but I literally drink like gallons and gallons of water every single day.
That's probably why your brain functions so well. What's your favorite restaurant?
Favorite restaurant, Porcupine Grill here in Salt Lake. They have got the best artichoke bread dip you've ever had in your life.
Oh, that sounds good. Tell me about your favorite dream car. What dream car you want?
A Mercedes E63 AMG 2018 Stage 2. I'm a huge car guy. So
what color?
Black, 810 horsepower, 920 pounds of torque.
Ooh, you're going to have to give me a ride for that, man.
I know
What's
my
your
car.
favorite song?
Favorite song would be,
That's a tough one.
Don't know if I have one specifically, but my daughters, I've got 3 little girls, and they listen to the new Frozen 2 nonstop, so I know every single word of the soundtrack.
Oh my God. Okay, how old do you want to live?
As long as I can.
Give me a number, man. Give me a number.
96.
All right. So tell me about your favorite destination, whether you've been there or a place that you want to go. Travel destination.
Place I want to be able to go and I want to take my wife is either Greece or overwater bungalows in Bora Bora.
Wow, that would be a good one. All right, favorite day of the year.
Favorite day of the year, March 14th, my wife's birthday.
Oh, that's very cool. And then what is your favorite way to celebrate a real estate closing?
Celebrate a real estate close is take a day off. So my wife, take a day off and take my wife anywhere she wants to go.
Awesome. I like that. All right, cool, man. I have fun with that segment. I appreciate you participating in that. So, and then with real estate syndication, let's go back a little bit into podcasting. Adam Adams, who you saw speak at the Raising Money Summit, likes to talk about don't approach this podcasting business from ready, fire, aim. He says, do it the other way, which is ready, aim, fire. He likes to have a bunch of episodes pre-recorded, focus on your audience. And I think some of the things that he suggests, like having your website up and getting a bunch of people to agree to give you a rating to help the algorithm so that you can get the most amount of listeners in the fastest amount of time. All of those techniques are awesome. But for me, I think if I had tried to do all of those things before I had launched, I probably would have never launched because I'm kind of one of those people that really needs to act impulsively in order to make things happen, or else I just move on to the next idea that comes my way. And I've been blessed that I did launch this. As soon as they brought me on board at Bakerson and said, hey, you know how to raise capital on social media? And I had done it using a social media platform or a thought leadership platform back during the crash, but I knew immediately that I had to launch a podcast. So I did it as fast as I could. I think within maybe a month or so after being hired, I had guests recorded and was just ready to launch. So
I think it's like kids.
You can approach it from the two aspects, and I don't think you're really, I'm kind of like what you said earlier is I had jumped with the parachute and formed a parachute on the way down. I learned to fly after jumping off the cliff, it's been phenomenal for me. I've loved it. I wouldn't go back and change it. But for people that are considering the podcast, those are things, food for thought, if you will. So with that, I'm very curious about if your focus is going to be on multifamily going forward, or are you going to be delving back into any other either asset classes or developments?
Multifamily, for
So
sure.
no mobile homes, no construction, no development of apartments, no opportunity zones,
For
no
the, for,
hotels.
for the first time, I've actually been able to start saying no to people when they bring us
Beautiful.
deals. I'm like, it's not in my lane. I can go look at a hotel, or I can probably figure out even something, an apartment that's student housing. I don't know how to underwrite it. I don't know the ins and outs. I'm going to stick with 12-month tenants because that's what I understand and know. We do look for deals that have value add play. And a lot of times, for instance, this apartment we're buying, it's 50 units. It's zoned for 110. We won't ever really get to 110, but there's the ability to build new buildings. The development experience comes in there. As far as like full-blown new construction development, start to finish, I don't know if that's in our lane. I don't know if we can compete in today's market with people who do that every day. We don't want to be good at everything. We just want to be good at like one or two things.
Yeah.
And that one or two thing is bringing value to value add investors and finding more off market deals than anybody else, which is why I'm in the same office as a whole entire marketing company.
That's really cool. And it says that right on your LinkedIn, which is really cool. Tell the audience how to get a hold of you. Where can they find you? What's your website? Where are you on social media?
So go to aimcapitalco.com, aimcapitalco.com, and you'll be able to see some of the funnel pages that Divulge Marketing has built. Or go find me. I'm on Facebook and LinkedIn, Christopher Huffman. I'm on quite a bit, so you guys can find me there. We connected through LinkedIn not more than a little while ago. So
it was like last week, dude.
Yeah, literally last week, and now I'm like, I feel like I've known you for forever.
That's the magic of conversation. Believe it or not, actually having conversations with people helps create a relationship. And for those people that, just give you a business card and never talk to them again, maybe spending a little time on the phone with them is a good idea, man. Who knows, man? Maybe we'll end up doing business together in the future. So that's been really cool, man. I love this conversation that we had. We really did almost like a case study on your entire investment career. So that was a lot of fun. Typically I like to talk about mindset and some other things that we didn't get a chance to because I was so interested in the process that you went to. But maybe next time we'll talk a little bit about, auto suggestion, Think and Grow Rich, spirituality, and who knows what else. But man, it's been fun having you. Thank you so much for coming on. We'll definitely stay in touch, man. Are you going to any conferences this year?
Yeah, I'll be at the Best Ever conference in February.
I'll see you there, man.
If you're not there, you've got to be there. And Ruben, this time when we're actually at the same conference, we're actually going to meet each other, which is going to be great. I'm looking forward to it.
Yeah,
but it's in Keystone, Colorado at the end of February. And other than that, I post every once in a while just upcoming conferences we're going to go to. I'll probably be at 3 or 4 this year. So yeah,
cool, man.
If you guys are ever in Salt Lake, let me know.
I'll look you up next time I go through. I drive through Salt Lake on my way to my friend's bed and breakfast in Montana. She lives right by Big Sky, so I'll definitely stop by if I can. All right, man. Thanks for coming on. I definitely look forward to staying in touch, and I'll see you in about 2 weeks, maybe a little bit longer than that, at Beck 20. Enjoy the rest of your day, man. Thanks for coming on.
Thanks, Ruben. See ya.
Peace.
We have existing cash flow day one.